Hi, I'm Brian Rezny, president of Rezny Wealth Management, a fee-only fiduciary investment management firm in Fort Myers, Florida. Today, I want to talk about structured products. You may have seen them marketed as a way to get market upside with downside protection, but there's a lot more to the story, and much of it is not in your favor. This is general information, not personalized advice. So what exactly is a structured product? At the simplest level, it's a package that combines a bond or fixed income piece with a derivative tied to a stock, index, or other investment. The pitch sounds appealing: participate in gains with protection if the market falls. But the reality is that these products come with trade-offs that most investors don't fully understand. Structured products became popular in Europe in the 1980s, spread throughout the 1990s, and took off in the U.S. after the 2008 financial crisis. They were positioned as a safe way to stay invested after the market crashed. But when real stress hit, many of those so-called protections didn't hold up. Investors learned that the protection was conditional, limited, or came with strings attached. Now let's talk about the real problems. First, the fees. Structured products often come with upfront fees of 1.5 to 5% or more, and that doesn't even include the embedded costs hidden in the product structure. These products are expensive. Second, complexity. To understand these products, you have to understand derivatives, credit risk, issuer risk, and payoff formulas that are anything but straightforward. Most retail investors simply do not know what they're actually buying. Third, limited upside and real downside. You may have a cap on potential gains while still being exposed to substantial losses if certain conditions are triggered. And in periods of market stress, liquidity can evaporate, meaning you may not be able to exit when you want to. And finally, poor net returns. Once you factor in the fees and trade-offs, many structured products underperform simpler, transparent alternatives. So why are structured products pushed so aggressively by some brokers and advisors? Because they are high-profit products. Under the suitability standard, a broker only has to show the product is suitable, not that it's in your best interest. That creates a conflict. And in many firms, structured products can come with large commissions. When incentives drive recommendations, the investor often loses. A real-world example is the Stifel-Nicholas case, where a broker generated tens of millions of dollars in commissions selling structured notes. Meanwhile, many of the clients holding those notes experienced significant losses. The broker made money. The clients took the risk. This is one of the reasons we do not use structured products at Rezny Wealth Management. As a fee-only fiduciary, we are legally required to put our clients' best interests first. The cost, complexity, conflicts, and downside risks simply do not align with a prudent long-term investment strategy. We prefer transparent investments where our clients clearly understand what they own, what it costs, and how it's managed. If you're ever presented with a structured product, here are some questions to ask. What are all the fees upfront, embedded, and ongoing? What is the worst case scenario and what triggers it? Can I exit early? And if so, at what cost? Is the person recommending this a true fiduciary, or are they operating under suitability? And most importantly, are there simpler, cost-efficient alternatives that achieve a similar objective? Thanks for watching. Structured products may sound attractive, but once you look deeper, they often don't align with the best interests of everyday investors. If you'd like to learn more about a transparent, fee-only fiduciary approach to managing wealth, feel free to reach out. This is general educational content, not investment advice. Always consult a qualified professional before making financial decisions.